OG John AG here. Silver has crashed 22% from its record high, down 17% in the past 24 hours. $1.1 trillion erased from its market cap, currently trading at $95 on COMEX, gold back below 5,000. And here's what makes this absolutely critical. In our previous video, we laid out the exact technical levels to watch. We said the 150-hour EMA, add it to your chart, would act as support, and initially, it did. Price bounced 10% before selling pressure broke that EMA, opening the path to the 90 to 95 support zone we identified. That's exactly where we are now, testing if it holds or breaks to 86. I shared this live on X. If you're not following me there, you're missing real-time charts and data I can't post here, and I'm just getting started. The handle is OG John AG on both X and YouTube. It's verified and can't be duplicated, so ignore the fakes. I don't sell anything. No courses, no signals, just unbiased information to empower independent thinking. Your feedback drives this. Comment below with where you're watching from and your price prediction for next week. I read them and will cover your questions. Now here's the part that should have everyone paying attention. While COMEX silver is trading at $95, Shanghai silver is trading at $136. The Shanghai premium just hit $36. 36. That's the largest premium we've ever seen. Physical silver in China is trading 37% above paper silver in New York. Let me say that again. Physical is 37% premium to paper. The safe haven asset is now trading with crypto-level volatility. Silver smashed $20 from $115 down to $95. Gold erased $4 trillion in 24 hours. Silver erased $1.1 trillion. This is extreme volatility. This is forced liquidation. This is the paper market breaking under the weight of leverage, while the physical market is screaming the exact opposite message. And speaking of the physical market, check these ratios. The gold-silver price ratio just rose to 51 to 1. Gold is trading at 51 times the price of silver. Meanwhile, the mining ratio is 1 to 8. For every 1 ounce of gold mined, 8 ounces of silver are mined. The COMEX vault ratio is 1 to 12. For every ounce of gold in COMEX vaults, there are 12 ounces of silver. The LBMA inventory ratio is 1 to 3. So we're mining silver at 8 times the rate of gold. We're storing it at 12 times the rate in COMEX. And it's trading at 1/51st the price. Does that make sense to anyone? And here's the kicker. The silver vaults are getting drained more by the day. Inventory is declining while the price ratio is expanding. Connect the dots. Now let's talk about what triggered this crash, because the timing is suspicious. Gold and silver prices started to fall at the open of trading in China, according to reports. Then the London Metal Exchange announced it has technical issues and a delayed opening. Silver got smashed $20 from $115 to $95 right as the LME delayed its open. Technical issues. Right. The LME delays open and sends silver down the mine shaft. There's not much fundamental news driving this except today's expected FOMC chair pick by Trump. That's the catalyst everyone is watching. If Trump picks a conventional Fed chair, markets might stabilize or continue selling. But if Trump surprises everyone and picks Judy Shelton as Fed chair later today, gold and silver could make a significant intraday rebound, and it would mark the end of decades-long price rigging. Let me explain who Judy Shelton is and why her potential appointment would be a bombshell for the banksters. Shelton is an economist, former Trump Fed nominee, and one of the most vocal advocates for sound money in modern times. Her ideas challenge the very foundation of the fiat financial system. She advocates for a gold standard to curb inflation and debt. She proposes gold bonds to reintroduce sound money gradually. Her ideas challenge the Fed's unlimited money printing power. Under a gold standard, the value of the dollar is tied to a fixed amount of gold. Inflation is controlled because money printing is limited to the gold reserves a country holds. Government debt can't spiral out of control because spending would be restricted by real resources. Monetary stability is restored, giving individuals and businesses confidence in the long-term value of their money. When Trump nominated Shelton to the Federal Reserve in 2020, her candidacy faced intense resistance. Why? Because Shelton's ideas challenge the Fed's ability to print trillions of dollars to bail out banks and inflate financial markets. A gold-backed system would restrict manipulation and force the Fed to act with accountability. Her nomination was blocked by a narrow Senate vote, but her ideas have gained traction. Recently, Shelton proposed gold bonds as a stepping stone toward sound money. The U.S. Treasury could issue bonds denominated in gold, not dollars. Investors could redeem these bonds in gold at maturity, bypassing the risks of fiat currency devaluation. This system would create a parallel market tied to real value, encouraging fiscal responsibility and offering a hedge against inflation. Gold bonds wouldn't replace the dollar immediately, but would lay the foundation for a transition to sound money. If Trump picks Shelton as Fed chair today, it would signal a fundamental shift in monetary policy towards sound money, away from unlimited printing. The implications for gold and silver would be enormous. The paper manipulation machine would face an existential threat. The decades of price suppression through derivatives and concentrated shorts would be under direct policy attack from the Fed itself. That's why today's announcement matters. That's why the timing of this crash is suspicious. That's why silver got hammered right before a potentially game-changing Fed chair pick. The banksters want to make you believe this is the real price of silver. It isn't. A $36 Shanghai premium is telling you the real price. A 51-to-1 gold-silver ratio against an 8-to-1 mining ratio is telling you the real price. Vaults getting drained while paper price crashes is telling you the real price. But here's the part most people are missing. In yesterday's video, we laid out these exact technical levels, and they're playing out precisely as we discussed. The 150-hour EMA held initially with that 10% bounce from 108 to 117, then it broke. We said if it breaks, we drop to early 90s. We're there now, testing 90 to 95 support. If this level holds, we can move higher. If it breaks, 86 is the next target. The roadmap is unfolding exactly as outlined, but here's what's different this time compared to every other silver crash in history. The physical market is not following the paper market down. Shanghai premium $36. That's unprecedented. In past crashes, premiums would compress or even go negative as physical sellers panicked. Not this time. Premiums are exploding. Physical buyers in Asia are paying 37% over COMEX spot to get metal. They're not scared. They're buying the dip aggressively. They know this paper price is fiction. Shorting won't end the shortages. It will only worsen them. The banksters are digging their own grave here. Every dollar they push the price down, the Shanghai premium expands. Every ounce they short on COMEX, the physical market absorbs and demands delivery. Every raid they conduct, Asian buyers step in harder. They're losing control and they know it. Now let's address the downside risks, because after a 22% crash, we need to be realistic. We're down from 121 to 95. That's a massive correction. If 90 to 95 support breaks, we could see 86 or lower. The technical damage is real. The momentum has shifted bearish short term. If you're trading on leverage, if you had tight stops, you got stopped out and liquidated. The volatility is too extreme for over-leveraged positions. 1.1 trillion in market cap erased in 24 hours is a liquidation cascade. Margin calls hit, forced selling happens, weak hands panic. That's the reality of trading in this environment. And here's the other risk. If Trump picks a conventional Fed chair instead of Judy Shelton, if there's no policy shift towards sound money, the paper manipulation could continue. The banksters could push silver lower. We could see more technical breakdowns. Lower levels could be tested before we find a real bottom. Bitcoin is also getting crushed, down to a 2026 low of 81,200, down 6.3%. Crypto is selling off, stocks are weak, gold below 5,000, everything is getting hit. If this is a broader risk-off move, if liquidity is tightening, precious metals could get dragged lower in the near term, even though they're supposed to be safe havens. But here's why the downside risks, while real for traders and short-term price action, don't change the structural physical market thesis. The $36 Shanghai premium is the largest in history. That's not a sign of weak demand. That's a sign of desperate demand. Physical buyers are willing to pay 37% over paper spot to get actual metal. They're front-running the squeeze. The gold-silver ratio at 51-to-1 against a mining ratio of 1-to-8 is screaming that silver is massively undervalued relative to gold. When this ratio is stretched this far, it historically snaps back violently. Silver outperforms gold on the rebound, and we're at one of the most extreme ratios in modern history. The vaults are getting drained, COMEX inventories are declining, LBMA inventories are under pressure. Shanghai is pulling metal east at a $36 premium. The physical market is tightening while the paper market is crashing. That divergence can't last. One of two things happens. Either COMEX price rises to meet Shanghai, or the COMEX pricing mechanism loses all credibility, and Shanghai becomes the price setter. And here's what validates our analysis. In yesterday's video, we called these exact technical levels, and they're playing out step by step. The 150-hour EMA held, gave us that 10% bounce to 117, then broke. We said if it breaks, early 90s is next. We're testing 90 to 95 right now. If this support holds, we move higher. If it breaks, 86 is the next level down. The technical roadmap is proving accurate in real time. Either way, the physical fundamentals are screaming shortage while paper is screaming liquidation. So where does this leave us? 3 key takeaways, and we're out. Number 1. The technical levels from yesterday's video are playing out with precision. 150-hour EMA held initially with a 10% bounce, then broke. Price dropped to early 90s as predicted. Now we're testing 90 to 95 support. If this holds, we move higher. If it breaks, 86 is next. The technical roadmap we laid out is unfolding exactly as discussed. Number 2. The physical paper disconnect just hit an all-time extreme. Shanghai premium, $36. Gold-silver ratio, 51-to-1 against mining ratio, 1-to-8. Vaults draining while price crashes. This is not a broken market. This is paper manipulation.